Millions of savers amass $1.2 million inside pre-tax retirement accounts by age 45, only to discover the IRS strictly locks every single dollar until age 59 and a half. If you attempt an emergency withdrawal early, the government slaps you with a crushing 10% penalty on top of ordinary federal and state income taxes. That fiscal double whammy instantly incinerates nearly 40% of your compound growth, forcing most diligent savers to abandon their early retirement dreams completely. Yet a savvy minority of investors legally bypass that age requirement, accessing seven-figure nest eggs in their 40s completely free of early withdrawal fines. If you want the calm, reality-based truth behind lasting wealth, hit subscribe right now. Let's examine how the 5-year Roth conversion ladder actually opens that locked vault. Imagine your traditional IRA as a heavily guarded grain silo, holding $1 million of untaxed harvest that you cannot directly consume without paying massive fines. To extract that wealth safely, you must shift chunks across a tax bridge into a Roth IRA, which operates like a tax-free personal checking account. When you convert funds from a pre-tax account into a Roth, the IRS treats that transferred amount as ordinary taxable income for that calendar year. Crucially, paying regular income tax on a conversion is completely different from paying an early withdrawal penalty, which applies only when cash leaves the retirement ecosystem entirely. Meet David, a 40-year-old engineer who just retired with $900,000 in his 401k and needs exactly $50,000 per year to cover his family's living expenses. Instead of cashing out directly and losing $15,000 instantly to penalties, David transfers a precise $50,000 slice from his traditional IRA into his Roth IRA. However, here's the catch. Tax law imposes a strict 5-year seasoning period on every single conversion block before you can withdraw principal penalty-free. Think of each annual $50,000 conversion as planting a slow-ripening fruit tree that takes exactly 60 months to yield harvestable, tax-free cash. Because of this mandatory 5-year delay, David cannot spend his first converted $50,000 immediately to buy groceries during year 1 of his early retirement. To survive those first 60 months without triggering IRS fines, David must rely on a separate cash runway held in standard taxable brokerage savings. He spends $50,000 from his accessible liquid reserves during year 1 while simultaneously converting his first $50,000 tranche over to the Roth side. In year 2, David converts another $50,000, creating a second distinct rung on his ladder that will mature exactly 5 years later in year 7. By repeating this disciplined annual process through years 3, 4, and 5, David systematically constructs a continuous conveyor belt of future tax-free income. When year 6 finally arrives, a magical milestone occurs. David's very first $50,000 conversion block fully clears the mandatory 60-month IRS waiting period. He can now withdraw that entire original $50,000 principal to pay for living expenses, completely unburdened by taxes or penalties, despite being only 46. During that same 6th year, David executes yet another $50,000 conversion, ensuring that his pipeline remains fully primed for his 11th year of financial freedom. Once the 5-year pump is primed, the bridge becomes self-sustaining, providing a perpetual penalty-free paycheck every single year until David turns 59 and a half. Let us examine the exact tax mechanics, because poorly executing these annual transfers can accidentally push you into a brutal, wealth-destroying federal tax bracket. When David leaves his job, his earned income drops to zero, dropping his marginal tax rate down to the lowest standard deductions. This zero-income retirement valley creates a golden window of opportunity to convert pre-tax dollars at remarkably low 12 and 22% federal tax rates. If David converted his entire $900,000 balance in one single year, the IRS would tax over half of that lump sum at 37%. By slicing the conversions into modest $50,000 annual increments, he fills up only the cheap tax brackets, saving nearly $180,000 in total lifetime taxes. There is another hidden trap that catches novice investors. You must never pay the conversion taxes using dollars from inside your traditional retirement balance. If David withholds $6,000 in taxes directly from his $50,000 conversion before reaching age 59, the IRS treats that withheld $6,000 as an early distribution. That mistake triggers an instant 10% penalty on the tax payment itself, completely destroying the mathematical efficiency of the entire conversion strategy. Let's look at David, a 45-year-old engineer who needs $40,000 annually to cover his living expenses. He cannot simply convert his entire pre-tax balance all at once. Converting a massive lump sum pushes your taxable income into the highest federal brackets, immediately destroying decades of carefully accumulated tax savings. Instead, David executes a precise annual conversion of $40,000 from his traditional IRA directly into his Roth IRA every single December. Because every individual conversion event has its own strict 5-year waiting clock, that first $40,000 stays locked completely out of reach. If David touches a single dollar of that specific converted principal before 5 full calendar years elapse, the IRS triggers that dreaded 10% penalty. This mechanical delay is precisely why building a 5-year bridge fund inside a standard taxable brokerage account is non-negotiable for early retirees. During those initial 5 years of early retirement, David lives entirely off his taxable investment account, selling index funds and paying zero income tax. Meanwhile, in the background, he systematically moves $40,000 from traditional pre-tax retirement accounts over to his Roth IRA each year like clockwork. When year 6 finally arrives, David reaches age 50 and the very first $40,000 conversion finishes maturing completely penalty-free. He withdraws that matured principal to fund his living expenses during year 6 while simultaneously completing his 6th annual Roth conversion for the future. The latter is now fully self-sustaining, providing a continuous perpetual pipeline of tax-free liquidity every single year until he reaches age 59 and a half. Now let's examine the exact tax mechanics of these conversions, because strategic bracket filling is where wealth coaches separate amateurs from masters. In 2026, the federal standard deduction allows a single filer to absorb the first $14,600 of income entirely tax-free. By converting $14,600 when you have no other earned wages, your effective federal tax bill on that transfer is exactly zero. Beyond that baseline, the 10% and 12% federal tax brackets offer historically cheap territory for moving additional pre-tax retirement funds across the fence. If David fills his 12% bracket up to $47,000, he pays a marginal tax rate that is a fraction of his working years. Paying a controlled, predictable tax today completely eliminates the risk of facing much higher required minimum distribution tax brackets in your 70s. Crucially, you must pay any income taxes generated by the conversion using separate cash directly from your taxable checking or brokerage accounts. If you withhold taxes directly from the traditional IRA balance during the conversion, that withhold portion counts as an early distribution subject to penalties. That single mechanical blunder could cost you $4,000 in unnecessary IRS penalties on a $40,000 annual transfer. Another critical rule to master is calendar alignment, because IRS clocks operate strictly on tax years rather than rolling 12-month time frames. If David completes a conversion on December 28, his 5-year waiting clock retroactively begins on January 1st of that exact same calendar year. That simple timing hack effectively shaves 12 entire months off his required waiting period instantly just by executing late in the fourth quarter. To properly document every step of this ongoing process, you must file IRS Form 8606 alongside your federal tax return each spring. Form 8606 creates an indisputable paper trail proving that your converted principal has already been taxed and can later exit without future assessments. Never rely solely on your brokerage firm to track conversion vintages, because custodian transfers often erase historical basis records during long retirements. You must also monitor the hidden trap of capital gains stacking inside your taxable account while you execute these annual Roth conversions. Because Roth conversions increase your adjusted gross income, they can inadvertently push long-term capital gains out of the 0% federal tax bracket. If David sells appreciated stock to pay living expenses, his $40,000 conversion might trigger unexpected 15% taxes on those investment gains. This delicate balancing act between ordinary income brackets and capital gains thresholds introduces another critical variable: your state of residence. To turn this 5-year waiting rule from a roadblock into a reliable income stream, you must construct your Roth conversion ladder, one rung at a time. Every successful conversion ladder requires an external bridge fund to cover your living expenses while your very first batch of conversions is aging on the shelf. Your bridge fund is simply cash savings or a taxable brokerage account that feeds you during the initial 60-month gap before your first conversion unlocks. Consider Mark, a disciplined saver who retires at age 50 with $800,000 inside his traditional IRA and needs exactly $40,000 every year to live comfortably. During his first month of early retirement at 50, Mark transfers exactly $40,000 out of his pre-tax traditional IRA and moves it directly into his Roth IRA. Because Mark is no longer earning a corporate paycheck, this $40,000 conversion represents his entire taxable income for that calendar year, drastically lowering his tax bracket. When you subtract the standard deduction of roughly $14,600 for a single filer, Mark's actual taxable income drops to just $25,400 for the entire year. That $25,400 figure puts him squarely inside the 12% federal tax bracket, keeping his total tax bill on a $40,000 conversion around barely $3,000. Instead of letting his pre-tax balance swell until forced minimum distributions hit at age 73, Mark systematically pays tiny tax bites at rock-bottom rates today. However, remember the strict IRS penalty mechanism. That freshly converted $40,000 is now legally locked inside his Roth IRA for 5 mandatory calendar years to pay for groceries, housing, and utilities during this first year of retirement. Mark withdraws $40,000 directly from his taxable brokerage bridge account. Selling shares in a taxable brokerage account generates long-term capital gains, which enjoy a 0% federal tax rate if your total income stays below specific IRS limits. This creates a brilliant dual tax optimization. Mark pays zero capital gains tax to live while simultaneously filling his lowest ordinary income brackets with cheap IRA conversions. Now advance to year 2 of retirement, when Mark turns 51 and repeats his exact same operational playbook without changing a single variable in his strategy. He converts another $40,000 from his traditional IRA into his Roth IRA, establishing rung number 2 and starting a brand new 5-year clock specific to this second batch. Each conversion year has its own independent 5-year countdown, operating like individual conveyor belts moving slowly toward tax-free liquidity at different intervals over time. A critical mechanical trap many novice retirees fall into is attempting to pay the conversion tax bill using dollars taken directly out of the traditional IRA balance. If you withhold $5,000 from your IRA to pay the tax man, the IRS treats that cash as an early withdrawal, triggering a 10% penalty. To protect your ladder and avoid all early withdrawal penalties, you must always pay the conversion income tax using external cash from your checking or savings account. During year 3 and year 4, Mark steadily builds rungs 3 and 4, moving another $80,000 total across the tax barrier into his permanent shelter. There is a fascinating calendar quirk hidden inside IRS Code Section 408A that savvy wealth builders exploit to legally shorten this waiting period. The IRS rules dictate that every conversion clock retroactively begins ticking on January 1st of the calendar year in which the transfer actually occurs. If Mark executes his annual conversion on December 20th, the IRS legally treats that money as if it entered his Roth IRA 11 months earlier on January 1st. That simple timing trick means his actual calendar wait time to access those funds penalty-free drops from 60 full months down to just 49 months. Finally, year 5 arrives when Mark turns 55, marking the magical financial milestone where the very first rung of his ladder fully matures and unlocks. That original $40,000 converted 5 years earlier at age 50 can now be withdrawn completely tax-free and penalty-free to fund his current annual budget. At this precise moment, Mark no longer needs to rely on his taxable bridge fund because his perpetual pipeline of maturing conversions is officially flowing. Every single January moving forward, another $40,000 rung finishes its 5-year seasoning countdown right on schedule, providing exact liquidity right when Mark needs it. By the time he reaches age 59.5, Mark has systematically extracted over $360,000 from his pre-tax accounts without paying a single dollar in penalties. Even better, what remains inside his Roth IRA continues compounding completely tax-free for the rest of his life, permanently safe from future government tax hikes. Executing your annual conversion during a market dip creates massive compounding leverage. When Mark converts $60,000 during a 20% correction, those discounted shares rebound inside his tax-free shelter. Let's check the exact tax bracket mechanics using the standard deduction. For a married couple filing jointly, that $30,000 deduction shields half of Mark's $60,000 conversion from federal taxes. Calculate the exact federal bill on the remaining $30,000 using the 10 and 12% marginal brackets. Mark owes only $3,100 to the IRS on that entire $60,000 conversion. That yields an effective federal tax rate of barely 5% on his retirement income. But where should Mark get that $3,100 cash without triggering unexpected early withdrawal penalties? Never pay conversion taxes using funds withheld directly from your traditional IRA. Withholding money from the pre-tax balance counts as a distribution, instantly triggering the 10% IRS penalty. Instead, pay that $3,100 tax bill using cash from your taxable brokerage account. This smart move preserves 100% of your converted capital inside the Roth tax shelter. Now let's examine the exact calendar rules governing the 5-year waiting clock. The IRS does not measure 5 individual 365-day years starting from the specific date of your conversion. Instead, every conversion made at any point during the calendar year retroactively starts its 5-year clock on January 1st of that tax year. This loophole creates an immediate advantage. If Mark converts $60,000 on December 20th of 2026, his 5-year clock is backdated to January 1st. He effectively shaves almost 12 full months off his total wait time. Thanks to this January 1st backdating, that exact $60,000 conversion becomes accessible penalty-free on January 1st, 2031. But what happens if Mark urgently needs cash in year 3? Here is where strict IRS ordering rules protect early retirees. When you withdraw money from a Roth IRA, the tax code always categorizes your distributions in a mandatory sequence. First out is your original direct contributions, completely tax-free anytime. Second out is your converted principal, ordered chronologically by tax year from oldest conversion to newest. Third and last in the withdrawal queue are your investment earnings. Because growth comes out dead last, you can safely extract seasoned conversion principal without ever touching taxable gains. However, there is a complex mechanism called the pro rata rule to watch. This accounting rule triggers if you carry existing pre-tax traditional IRA balances alongside after-tax contributions. Luckily for standard conversion ladders fed from a pre-tax 401k rollover, the pro rata calculation works smoothly because all dollars being moved are fully pre-tax and cleanly counted. But how does a $60,000 annual conversion impact your healthcare costs before age 65? This is where many early retirees accidentally lose thousands in government health subsidies. Under the Affordable Care Act, your conversion amount directly increases your modified adjusted gross income. Every converted dollar counts as taxable income on your ACA subsidy application. If Mark converts $80,000 instead of $60,000, his higher MAGI slashes his monthly premium tax credits by $400. That hidden cost acts like an extra 24% surcharge. To prevent this subsidy trap, smart wealth builders coordinate their annual conversion targets with the ACA federal poverty level percentage brackets every November before the year ends. By capping Mark's taxable conversion right at $59,000, he stays comfortably below the 300% poverty line, securing cheap silver tier health coverage while maximizing his low tax bracket. What about state income taxes? While states like Texas and Florida charge zero tax on Roth conversions, high-tax states can grab up to 13% right off the top. If you plan to relocate in early retirement, delaying conversions until after establishing legal residency in a no-tax state legally saves $7,800 a year on every $60,000 rollover. Now let's trace the exact cash flow mechanics during year 5 of Mark's retirement, a magical milestone when his initial waiting bridge finally connects to his ladder. In January of year 5, Mark withdraws the $60,000 conversion principal he created back in year 1, completely tax-free and penalty-free, covering his entire annual living budget. Simultaneously, during that same year 5, Mark executes a fresh $60,000 conversion from his pre-tax balance, planting a new tax-free rung that matures perfectly for year 10. The ladder has now transformed into a perpetual self-sustaining loop. Every single January, an old 5-year rung unlocks for expenses while a new rung is planted for the future. By the time Mark celebrates age 59 and a half, he had systematically extracted $900,000 from his pre-tax accounts without ever paying $1 in IRS early penalties. Even better, when required minimum distributions begin at age 73, Mark's traditional IRA balance is minimal, shielding him from forced withdrawals that push seniors into top tax brackets. Look beyond standard assumptions. What happens if a multi-year bear market strikes right midway through your ladder? Converting fixed dollar amounts during a crash requires a strategic pivot. When share prices drop 30%, converting that exact same $60,000 moves 42% more share volume into your Roth shelter for the exact same tax cost. Transitioning beyond basic tax brackets brings us to one of the most dangerous hidden traps of the ladder: healthcare costs before Medicare. Every single dollar you convert from a traditional IRA to a Roth IRA counts directly as modified adjusted gross income, or MAGI. If your annual conversion pushes your MAGI above the ACA subsidy cliff, you could instantly forfeit thousands of dollars in health insurance tax credits. For a couple retiring at 50, keeping taxable conversions under that silver plan threshold easily saves roughly $8,000 every year on insurance premiums. To protect these health subsidies without starving your lifestyle, you must strategically cover living expenses using cash from taxable brokerage accounts instead. Another powerful mechanism is timing your annual Roth conversions to align perfectly with severe stock market downturns and temporary portfolio corrections. When the S&P 500 drops 20%, converting $40,000 worth of shares moves 20% more actual asset shares into your permanent Roth fortress. You pay income taxes on that depressed $40,000 valuation today, but the eventual market rebound happens entirely tax-free inside your Roth account. Think of market crashes as an IRS clearance sale where future compounding shifts from tax-deferred to tax-free at a steep discount. Even if the stock market trades sideways for 3 consecutive years, your crucial 5-year conversion clock continues ticking forward without interruption. Beyond federal brackets, state income taxes create massive financial arbitrage opportunities during your early retirement gap years before Social Security begins. If you built your wealth in California paying 9% state tax, executing your conversions while residing in zero-tax Florida saves $3,600 per $40,000 conversion. Even a temporary 2-year relocation during your initial conversion sprint can permanently shield 6 figures of retirement assets from state tax authorities. However, you must establish legitimate legal domicile with voter registration and physical presence before executing those high-dollar conversions across state lines. Aggressive state revenue departments regularly audit early retirees who attempt paper-only address changes simply to bypass substantial state conversion taxes. To prove your conversions are fully seasoned when audited, you must meticulously file IRS Form 8606 for every single conversion year. The IRS enforces strict ordering rules when you withdraw from a Roth IRA. Contributions exit first, conversions second, and earnings last. Because your original contributions can be withdrawn tax-free and penalty-free anytime, they act as an essential liquidity bridge during your initial 5-year wait. If you pull out $15,000 for living expenses, the IRS automatically assumes it came from your original contributions before touching any converted funds. Only after every single dollar of original contributions is completely exhausted do your 5-year conversion tranches begin flowing out sequentially. If you fail to systematically drain your traditional IRA before age 73, the government forces massive required minimum distributions upon your accounts. These mandatory RMD withdrawals easily push you into the 32% tax bracket and trigger expensive Medicare IRA surcharges on your monthly healthcare premiums. By aggressively executing conversion ladders throughout your 50s and 60s, you systematically diffuse this sticking RMD tax bomb decades in advance. You are intentionally making the strategic choice to pay a controlled 12% or 22% tax rate today to prevent forced 32% taxation later. Remember that once your money successfully crosses over into a Roth IRA, those dollars are permanently exempt from all lifetime required minimum distribution laws. This conversion strategy also shields your surviving spouse and adult children under the restrictive inheritance guidelines mandated by the Secure Act. Non-spouse heirs who inherit a traditional IRA must completely drain that account and pay all income taxes within just 10 short years. If your daughter inherits $500,000 of traditional IRA assets during her peak earning years, federal and state taxes could easily consume almost half. When she inherits an aged Roth account instead, that exact same 10-year window delivers $500,000 of pure tax-free wealth directly to her. Mastering these exact conversion mechanics separates average savers from those who build multi-generational tax bulletproof wealth structures that endure for decades. As your ladder approaches age 62, every dollar converted stops being just about early retirement access and starts defending against aggressive tax traps later in life. Specifically, claiming Social Security exposes you to the infamous tax torpedo, where up to 85% of your benefits suddenly become taxable due to high traditional IRA withdrawals. By aggressively draining your pre-tax accounts in your 50s, you systematically lower your future combined income, keeping Social Security benefits completely protected from federal income taxation. Next comes the surviving spouse tax trap, a major risk where the surviving partner suddenly gets pushed into drastically compressed single-filer income brackets. Inheriting a massive $1.5 million traditional IRA forces the survivor to take huge RMDs right at single taxpayer rates, destroying thousands in wealth every year. Completing a Roth ladder early eliminates this widow's penalty entirely because qualified Roth distributions never add to a surviving partner's adjusted gross income. For practical execution safety, always run your final conversion numbers in late December when your exact annual income and deductible expenses are completely known. Crucially, always pay the resulting tax bill using external taxable cash, like a high-yield savings buffer or brokerage account, rather than withholding directly from the conversion. Withholding even $5,000 in taxes directly from the traditional IRA before age 59.5 triggers an immediate $500 early withdrawal penalty plus unnecessary ordinary income taxes. Also, during market downturns, never sell depressed assets to fund conversions. Instead, convert shares in kind directly into your Roth account to capture the tax-free rebound. Shifting 100 depressed shares valued at $8,000 locks in a tiny tax bill while letting the future recovery to $20,000 happen entirely tax-free forever. That is the true power of the Roth conversion ladder, bridging early retirement while permanently diffusing future RMD tax bombs before the IRS touches your capital. Hit like if this saved your retirement timeline and comment your target conversion tax bracket below. Subscribe for lasting wealth and watch this video on ACA subsidies next.